All right, let's work with continuing concepts in the corporation's equity. One of the concepts we work with in this chapter is the issuance of dividends. When a company has two types of stock, preferred stock and common stock, and they issue a total dividend to all stockholders, they have to divvy that dividend up or spread it across two different types of stockholders. So the way we're going to do that is by looking at the amount that should go to preferred shareholders because they will be paid first. So working at the stockholders equity section of Ernst Company, there are 80,000 shares of $5 par value, 8% cumulative preferred stock. They also have 250,000 shares of $1 par value common stock. Both classes of stock have been outstanding since the company's inception. Okay, so that tells me they haven't bought any of this stock back. They did not declare any dividends last year, but now they are declaring and paying a $110,000 cash dividend at the end of the current year. They're trying to decide how much of that $110,000 will go to the preferred shareholders and how much will go to the common shareholders. So we're going to determine that exact thing. So the first thing we need to think about is what is supposed to go to the preferred shareholders. And we need to zero in on this stated dividend rate. This percentage is telling whoever buys this stock that if the company issues dividends, they will receive 8% of the par value in the form of a dividend. So what we need to do is figure out how much preferred shareholders are supposed to receive if the company declares dividends. Okay, so let's do some math here. 80,000 shares at $5 per share. Total par value of the stock is 400,000. 8% of that is the stated dividend rate. So in other words, we're telling shareholders that at $5 per share times 8%, each share of stock will receive 40 cents in dividends. We have 80,000 shares at $5 par value at 8%. The total amount of the dividend would be, they took it a step further, so let me break it down, 32,000, which is 8% of the par value of the stock. So $32,000 of dividends should be paid to the preferred shareholders every year. The other thing we need to pay attention to is the fact that this preferred stock is cumulative. That means that if the company does not pay stock in a given year, we have to keep track of and accumulate any unpaid dividends. So remember, this company did not declare and pay dividends in the last year. So preferred shareholders did not receive any dividends last year. They should have received 32,000. They received nothing. Because it is cumulative, we have to keep track of unpaid dividends. Those unpaid dividends are called dividends in arrears. There are $32,000 of dividends in arrears. So we need to, in the new year, in this year, when dividends are being paid, we have to pay not only the current year dividends, but we also have to pay last year. Preferred shareholders should receive $32,000 per year. They didn't receive any last year, so we owe them for last year plus this year, so we owe them for 2 years. Thus, we owe $64,000 of dividends to preferred shareholders. In total, the corporation is paying $110,000 in dividends. $64,000 of that will have to be paid to the preferred shareholders, which means there's only $46,000 worth of dividends left to pay to the common shareholders. Okay. Key concepts here: preferred shareholders are paid first. They are paid based off of their stated dividend rate 8% of their par value. And if it's cumulative, we have to pay any unpaid prior year dividends along with the current year dividends. If the stock was non-cumulative, then we could ignore any unpaid dividends in the past. But this is cumulative, so we had to pay attention to that. Any amounts remaining after the preferred shareholders receive their share of current year and any prior years, if applicable, the remaining will then go to the common. Okay, so now that we know how dividends are distributed across two different types of shareholders, let's go in now and look at the accounting for dividends. Okay. So we're going to prepare journal entries for these transactions of Emerson Corporation. July 15th, they declared a cash dividend that will be payable to common stockholders, $165,000. Three important dates associated with dividends. The first is the date of declaration. July 15th is the date they identified or declared a dividend will be paid. As soon as the board of directors declares they will be paying a dividend, there is an obligation. Thus, we need to record a liability in the general ledger. The amount of that dividend in total, $165,000. And this dividend is going only to common, so it makes it really easy for us. But we are going to credit common dividend payable. It's a liability for $165,000. Okay. Remember, we are using the company's profits to pay this dividend. So we are going to be decreasing retained earnings at the time of the declaration. Okay. All right, so that was the date of declaration. Liability recorded, retained earnings decreased. August 15th is the date of record. On the date of record, there's nothing for us to record in the general ledger. It's just simply a date that the company would go out and figure out who owns the stock so that they know who they're going to pay. So they're just coming up with a record of owners. August 31st is the date the payment is actually being made for that dividend. So the only thing we record on the date of payment, the third important date, is the payable being paid off. We're going to decrease the liability with a debit and credit cash. Date of declaration, decrease retained earnings and record a liability. Date of record, no entry required. Date of payment, liability is paid. Shareholders actually receive their payment. All right, now let's take a look at a stock dividend. Right, corporations can issue stock a couple different ways, or issue a dividend a couple different ways. They can issue a cash dividend, or they can issue a stock dividend. In a stock dividend, they're distributing additional shares of stock out to the shareholders. So let's assume that Epic has 10,000 shares of $2 par value common stock outstanding. They have declared a 5% stock dividend on July 1st when the stock's market value is $8 per share. It will be distributed on the July 20th. We're going to prepare journal entries for the declaration and distribution dates of the stock. Okay. All right, so first things first. They are issuing a 5% stock dividend, which means they are issuing an additional 5% of the total stock out there. So 10,000 shares at 5%, they're issuing an additional 500 shares. Remember, all dividends are paid out of accumulated profits. So we are going to decrease retained earnings for the amount of this dividend. So what are these 500 shares worth to stockholders? Well, if they were to buy the stock from some other shareholder out on the market, the market price of this stock is $8 per share, which means the true value of this dividend, the true value of these 500 shares, is their market price, or what they are trading for on the market. So 500 times 8 means the total value of this dividend is $4,000. That is the total amount of profits that we are going to pull out of retained earnings, decreasing retained earnings for the full value of the dividend, $4,000. When we go to issue this stock, we're going to be recording it as a stock issuance. We need to increase our common stock, but because the stock is not being issued on the date of declaration, what we need to do is essentially obligate some additional shares of stock by recording it into a temporary, kind of what I want to call a temporary holding account. And that holding account is called common stock dividend distributable. This account is saying, listen, we are going to issue this stock. It's obligated to be issued, but we haven't actually issued it yet. So we're not going to record it into the common stock account because it's not issued. Instead, we are going to record it in this little holding account until we issue it. The amount we record in there is going to be the par value or stated value of the stock. So the 500 shares, the stock has a $2 par value. The total par value of stock to be issued is $1,000. So we will credit the common stock dividend distributable account. That means that when the stock is issued, there will be an additional $4,000 paid into capital over and above the par value. So we're going to record that $3,000 into the paid in capital and excess account for common. Take a look what's happened here. The company's retained earnings or accumulated profits are decreasing. They're going to be used to issue more stock to shareholders. That means that the total amount of profits are going to be reinvested into equity is $4,000. $1,000 of it is the par value. The other $3,000 is the excess that will be paid into capital over par. Okay, the total investment is coming from profits, from retained earnings. Okay, so that happened on the declaration date. Retained earnings decreased to fund the dividend. We have set aside or obligated some common stock to be distributed, and we recorded the excess being paid in from profits into the paid in capital and excess account. Now on the date of distribution, that is when this stock will actually be distributed. Okay. There is a date in between here, the date of record, but again, there's no entry on the date of record. On the date of distribution, this account will then decrease. So we will debit the common stock dividend distributable, and that is the date the stock is actually issued. That is when we record it into the stock account at its par value. Okay, so let's look at the impact on equity or on retained earnings as a result of the stock dividend. Okay, so remember I was mentioning in the last problem that in a stock dividend, the company is using its profits and reinvesting into its paid-in capital. So retained earnings goes down, but paid-in capital goes up. Okay, and total equity doesn't change. Look at the stockholders' equity section of June company's balance sheet as of April 1st. So before anything happened, they had common stock of $1 million, PIK account 600, so $1.6 million had been paid into capital, and the company's accumulated profits were $833. Total stockholders' equity of $2.433 million. On April 2nd, the company declares and distributes a 10% stock dividend. The stock's per share market value on April 2nd is $20 just prior to the dividend. In order to see the impact on the equity accounts, let's just look at what the journal entry would be. When that dividend is declared, we would decrease retained earnings for the total value of the dividend to shareholders. So let's figure out what the total value is. There are 200,000 shares issued and outstanding. They are issuing a 10% stock dividend. they're issuing an additional 20,000 shares. 20,000 shares will be issued. The current market value is $20. So multiply the number of shares times 20. The total value of this dividend to shareholders is 400 grand. They're getting 200,000 shares that are currently being sold on the market for 400. Retained earnings will be decreased for the total value of the dividend, 400 grand. When the stock is distributed, those 200,000 shares, 20,000 shares, 10% of the 200, will be recorded into the common stock account at $5 per share. So 200,000 shares at a 10% stock dividend, 20,000 shares at a $5 par value. Total par value of the stock to be issued 100. So retained earnings would have been decreased 400. Common stock would increase 100. Okay, and we kind of skipped past the dividend distributable account. We're just kind of looking at total summary of the stock issuance. The excess would go into the PIK account. So let's look at the changes to the equity accounts. Retained earnings will go from 833. It is decreased 400. Its balance goes down to 433. Common stock. It was 1 million before the dividend. It was increased 100, causing its balance to end up at 1.1 million. The paid-in capital and excess balance prior to the dividend was 600. It increased 300,000, bringing its balance up to 900. So now if we look at the stockholders' equity after the dividend, common stock had a $5 par value, 375,000 shares authorized to be issued over the life of the stock. There are now 220,000 shares issued and outstanding, because we just issued a stock dividend of 20,000 shares. None of them have been bought back and held in treasury, so they are still outstanding, held outside the corporation. Paid-in capital in excess, total paid-in capital of 2 million, retained earnings of 433. Lo and behold, total stockholders' equity did not change. The composition of it did. Prior to the dividend, 1.6 million was the amount of paid-in capital, but now it is 2 million because some of the profits were taken out of retained earnings. Retained earnings went down 400 and have been reinvested into the owner's equity. So stock dividends are really seen as a reinvestment in the company's equity, right? Taking profits and reinvesting in themselves. Whereas cash dividends take company profits, retained earnings goes down, and pays it outside of the company in the form of cash. All right, let's go ahead and pull together dividend concepts from this chapter along with some treasury stock transactions from the prior chapter. Balthus Corporation reports the following components of stockholders' equity at December 31st of last year. So this is where they ended last year. Then the following transactions occurred related to stockholders' equity this year. We are going to prepare journal entries to record each of these transactions. January 10th, the company purchased 40,000 shares of its own stock at $12 cash per share, buying its own stock back off of the market to hold it in treasury. We are going to record that into the contra equity account, treasury stock, by debiting it, increasing its balance, causing overall equity to go down, and credit cash for the total cost. 40,000 paid $12 per share, $4.80. Again, that was covered in the previous chapter example problems. March 2nd, the directors declared a $1.50 per share cash dividend that will be payable on March 31st to the March 15th stockholders of record. Date of declaration for a cash dividend. The company is obligated to pay this dividend. They are going to take some of their profits out of retained earnings and record a liability. $1.50 per share. Well, they have 200,000 shares issued and outstanding when they started the year. But remember, they repurchased some of their own shares, and so 40,000 of those 200 are now held in treasury. So they only are going to pay a dividend on 160,000. 200,000 started the year outstanding, 40 were bought back, only 160 are outstanding. At $1.50 per share, total dividend of $2.40 will be paid. Retained earnings will be decreased. Liability to pay that dividend increased with a credit. All right, March 15th, stockholders of record, no journal entry required. Just a date to determine who's going to be paid. March 31st, date of payment. On the date of payment for a cash dividend, the liability recorded on the date of declaration is paid. So we will decrease the liability and credit cash because cash is being paid. November 11th, they sold 24,000 of its treasury shares at $13 cash per share. They had purchased 40,000 shares at $12 per share and recorded it into the treasury stock account. They are now reselling 24,000 of those shares. So this stock needs to be, this treasury stock account needs to be decreased because some of the stock is no longer held in treasury, it's resold. We're going to decrease the treasury stock account for whatever amount the stock was recorded in there. It was recorded in there at its cost of 12, so we are going to decrease the stock at $12 per share. 24,000 times 12, 288,000. We will decrease the treasury stock to 88. We are selling those 24,000 shares for $13 cash per share. 24,000 at a selling price of 13. We are going to bring in cash of 312,000. Cash of 312 is being paid in for stock that had cost us 288. We have an excess being paid over and above the cost of 24 grand. So we put it into the paid in capital and excess on treasury stock. On November 25th, we sold the other 16,000 of our treasury shares at $10.50 per share. All right, so again, we are going to decrease our treasury stock account for its cost. $12 per share is what it was purchased for. We are going to decrease treasury stock, 16,000 being sold at 12, 192 grand. Treasury stock goes down 192. Amount of cash being received is the number of shares, 16, being sold for $10.50, cash of $168. We received cash of $168 for stock that we repurchased at $192. We sold it for less. There's a deficit here. We need to fund that deficit as much as we can from our paid in capital treasury stock account. There is currently a balance in that account of 24 grand because I increased it in the November 11th transaction. So now I know that it has enough of a balance to absorb all of my deficit. So I will decrease the paid in capital on treasury stock for the full 24 grand deficit. Again, if there had been a bigger deficit than what the balance of that treasury stock paid in capital account could absorb, any excess unabsorbed deficit would come from retained earnings. All right, December 1st, the directors declared a $2.50 per share cash dividend payable on January 2nd to December 10th stockholders of record. All right, so they're making another dividend declaration. The company is obligated to pay this dividend now. They need to decrease retained earnings for the amount of the dividend and record a liability. How many dividends or how many shares are they paying the dividend on? Let's go back and think it through. Started the year with 200,000 shares outstanding. They repurchased 40,000 of them. So the last time they paid dividends, they only paid dividends on 160,000 shares that were held outside the corporation. But since that last dividend, the company resold 24,000 and another 16,000. So it resold all of the treasury shares. So the number of shares now held outside the corporation is back up to the 200,000. Okay, there's no more shares held in treasury. They've all been resold. All 200,000 are held outside the corporation. So the dividend will be 250 times the 200,000 shares, or 500 grand. We will decrease retained earnings 500 and record a liability of 500. December 10th, stockholders of record. Again, there's no entry, just a date to determine who will be paid. And it's not January 2nd yet, so we can't record the payment of that liability. The last thing we do during this year is the company had closed $1,072,000 from net income in the income summary account to retained earnings. This takes us all the way back to chapter 3, I think it was, where we learned the closing entries. The closing entries, or excuse me, chapter 4, whatever that chapter was, those closing entries close revenues and expenses into income summary. And back then we closed income summary into a partner's capital account. But now with a corporation, when we close income summary, we close it to retained earnings. So we're going to decrease that debit or that credit balance in income summary with a debit, decreasing, closing out income summary, and recording it, the amount of net income, into retained earnings with a credit. Okay. All right, so we have now gone through, done all these transactions for the year. Let's prepare a statement of retained earnings for the current year ended December 31st. All right, so let's think through the statement of retained earnings. Okay, the statement of retained earnings is going to show anything that caused retained earnings to change. Well, we started the year with $2,160,000 in retained earnings. Net income would have increased retained earnings, because remember our journal entry, when we closed net income, we increased retained earnings. Retained earnings would have decreased by any cash dividends declared. We had 2 dividends declared. On March 2nd, we decreased retained earnings for $240. Then we decreased retained earnings again on December 1st for that second dividend declaration. Total of $740,000 of dividends were declared. Even though they weren't both paid, they were both declared, retained earnings was decreased on the date of declaration. So retained earnings would have ended the year with $2,492,000. Okay. So we have an ending balance in retained earnings to prepare the total stockholders' equity section. None of these transactions affected paid-in capital. No more treasury stock, so the only difference from the beginning of the year is going to be the retained earnings, which ended with $2,492,000. So total stockholders' equity, $4,092,000. The change from beginning of the year to the end is primarily due to the increase in retained earnings from net income, less the net income, the profits that were paid out in the form of dividends. All right, I hope this helps with the concepts in this chapter.